Before you wire money into a multifamily deal, let me ask you something uncomfortable. When you open the investment deck, do you actually know what you're looking at? Or are you scanning for the IRR, glancing at the preferred return, looking at a few charts, and trusting that someone else did the hard thinking? Because here's the truth. Most investors don't lose money because the market collapses. They lose money because they didn't understand the structure of what they invested in. The risk was visible, it was in the assumptions, it was in the debt, it was in the exit model. They just didn't know how to read it. In the last video, we broke down the 7 red flags that quietly destroy multifamily deals. And today I'm going to show you how to spot those red flags yourself by walking through how to read a deal package like an operator. And midway through this video, I'll show you a real numerical example of how one line in a pro forma can change your outcome by millions. If you're allocating 6 or even 7 figures into a deal, you cannot afford to read like a spectator. You need to read like an owner. Let's get into it. If we haven't met, I'm Adam Williams, founder of Elevest Capital. I've spent over 20 years investing exclusively in multifamily real estate. Last year alone, we completed over $200 million in transactions and added more than 1,300 units to our portfolio. We've reviewed thousands of deals, closed dozens, passed on hundreds, and I can tell you with certainty, most weaknesses in a deal are visible long before the first distribution is ever sent, but only if you know where to look. Today, I'm going to walk you through exactly where that is. Here's what makes this dangerous. Modern deal packages don't look institutional. Professional branding, sharp design, clean charts, polished webinars, but presentation quality has nothing to do with structural durability. In fact, some of the most fragile deals I've ever reviewed had the best marketing. So here's the shift you need to make. Stop asking, what does this project? And start asking, what assumptions must be true for this to work? Because every deal package is built on assumptions. Rent growth, expense growth, debt cost, exit cap rate, refinance timing. If those assumptions are aggressive, your capital is exposed. So let's break this down practically. When you open a deal package, here's the order institutional operators analyze it in. Not the order it's presented, the order of risk. Step 1, let's start with the debt. Most investors skip this section. That's a mistake. Debt determines the survival. You should ask, is it fixed or floating? If floating, is there a rate cap? When does it mature? What are the extension options? Is it interest only? Let's walk through a simplified example. Let's say the purchase price is $50 million and you have 75% leverage. That's $37.5 million in floating rate debt projected at 4%. Year 1 projected interest is $1.5 million. Now assume rates move to 6.5%. Interest becomes $2.44 million. That's nearly $940,000 more per year. If projected NOI was $3 million, your debt coverage ratio just collapsed. And if the deal was thin to begin with, you're now in capital call territory. Before you ever look at IRR, you should know how fragile the debt is. And we haven't even touched rent assumptions yet. Step 2, analyze rent growth assumptions. Flip to the pro forma. Look at annual rent growth. If you see 5, 6, or even 7% annual rent growth for multiple consecutive years, it's a hard pass. Let me show you why. Let's say it's 200 units with an average rent of $1,400, 5% annual rent growth for 5 years in a row. That gets you to roughly $1,785 per unit, an increase of $385. Across 200 units equals $77,000 per month or $924,000 per year. At a 6% exit cap, that's $15.4 million in valuation increase. Now reduce rent growth to 2%. That valuation bump shrinks dramatically, often by $8 to $10 million. That delta doesn't show up early, it shows up at exit, which means you won't feel it until it's too late to correct. Here's the institutional rule. Underwrite for durability, not for optimism. Step 3, examine expense assumptions. Now look at operating expenses. What's the assumed annual growth? 2%, 3%? Assurance alone in many markets has increased 15 to 20% in certain years. Property taxes get reassessed at purchase. Payroll rarely shrinks. If expense growth is understated by even 2% annually over 5 years, that compounds significantly. Here's a quick illustration. Starting expenses of $2 million, projected growth of 2% annually, actual growth of 5% annually. By year 5, projected equals 2.16 million, but actual equals 2.55 million. That's nearly $400,000 in variance. At a 6% cap, that's over $6.5 million in valuation impact. Small assumption, but a massive outcome shift. Let's get into step 4, exit rate cap sensitivity. This is where sophistication really shows. What exit rate cap is assumed? If entry cap is 5.5% and exit is projected at 5.5% or lower, you're depending on market expansion. You need to ask the sponsor to see their sensitivity analysis, which is rarely shown in the shiny marketing package. For example, if you buy at 5.5% and exit at 6 or 6.25%, let's quantify what a half a point looks like. If NOI at exit is $5 million, at a 5.5% cap, valuation is $90.9 million. At a 6 cap, that's a $7.6 million difference. Cap rate sensitivity alone can erase equity gains. If the deal only works at an aggressive exit cap, it's structurally fragile. And we haven't even looked at the fee structure yet, which may determine whose downside is protected and whose isn't. At this point, you should feel something. Not fear, but awareness. Because here's the reality. Most deal packages are designed to highlight the upside. Institutional operators read them to locate fragility. When you shift from projected returns to structural mechanics, everything changes. You stop asking, what's the IRR? And you start asking, how does this break? That shift alone moves from passive participant to capital allocator. And capital allocation requires engineering, not hope. Now let's filter a deal package through passive. Predictability. Are income projections conservative and diversified? Alignment. How much capital is the sponsor investing? Are fees backloaded toward performance? Safety margin. Is leverage between 60 and 70%? Are reserves meaningful? Scalability. Is there professional property management and operational systems in place? And are these fully integrated or are they outsourced to a third party? Inflation resilience. Can rents adjust annually? Are expenses controlled? Volatility exposure. Is performance driven by operations or dependent on market appreciation? And exit clarity. Are multiple exit strategies outlined? Is refinancing realistic? If a deal struggles in 3 or more of these categories, it's not institutional grade. And if it's not institutional grade, it doesn't belong in a portfolio designed for durability. For over 20 years, multifamily has been the vehicle I've used to build my family's wealth. But here's what most people don't see. We pass on over 97% of the deals we underwrite because protecting capital matters more than projected returns. The discipline isn't in buying, it's in declining. Multifamily works, housing demand is durable, but only when structure leads strategy. My mission is to help people just like you create real wealth and passive income through investing in multifamily real estate. It's how I've built my family's fortune over the last 2 decades, and in my opinion, it's one of the most trusted ways to build lasting wealth. But durability isn't found in a pitch deck. It's found in the details you must ask the hard questions to uncover. There are 2 types of passive investors, those who read for returns and those who read for risk. One scans the upside, the other searches for fragility. One hopes the operator got it right, the other verifies. Hope-based investor or income engineering investor. The difference isn't intelligence, it's discipline. And discipline needs to show up before you wire capital. So the next time a deal hits your inbox, don't ask how much it can make, ask how it can fail. That's how capital compounds over decades. If you're serious about allocating capital to multifamily and you want a disciplined institutional second set of eyes before you commit, visit elevestcapital.com. Book a call with our team. We'll evaluate your goals, your current portfolio, your income targets, and whether our multifamily strategy aligns with your objectives. This isn't a sales pitch, it's structural evaluation. And in the next video, I'm gonna walk you through how institutional investors stress test deals for downside, including recession models, rent compression, and liquidity freezes. Because reading the deal is step 1, but stress testing it is where the real confidence is built. I'll see you there.